Okay, we are now looking at problem 9-5A in Wiley Plus. This one's a little bit more difficult in that you have some big numbers to work with, and we're going to be selling items partway through the year and then doing an updated depreciation entry that is a little tougher than it sounds, simply because we have a new asset that you'll see that we'll buy on July 1 that we have to do separate than all the rest of the assets that we have prior to this July 1 purchase. Mainly because all the other assets we've already had for quite a long time. This new asset, we can't depreciate it with all the others because we've only had it for a half a year. If we would throw it in with all the others, we would be depreciating it for an entire year when that's not the case. All right, so with that said, what I've done is I've created some T accounts here with all of our opening balances, and you'll want to do this on a side sheet of paper as well with your numbers. So I've got the land, I've got the building and its contra account, the accumulated depreciation, and the equipment along with its contra account, the accumulated depreciation. And I've got all their balances. You're going to want to do this for a couple reasons. One, to help figure out depreciation at the end. And two, the second part of this problem asks you to go ahead and update the balances on the balance sheet and say, what's our brand new land balance? If you've already been keeping the T accounts, it's very easy for that piece. All right, so what I'm going to do here off to the side is I'm going to be doing the journal entries and then updating these 5 T accounts whenever it needs to be done. So on April 1, this one's very easy. We purchased land, but let's first read through the rest of the instructions, because it'll tell us in the instructions that every purchase or every sale was done with cash. So that's going to be important to know. And when we do the depreciation, it's going to be done via straight line depreciation. The last thing that we need to know is the useful lives of the items that we do have currently. The building has a useful life of 5 years, or 50 years, no salvage value. And the equipment has a useful life of 10 years, with, again, no salvage value. We're going to record everything as though cash was received. All right, so for our first entry, we purchased land for $2,189,000. So the debit question here, what did I get on April 1? I got land, and the land cost me $2,189,000, and I got it via cash. And I'll make that a little bigger. That one's very easy so far. So I can just update my land T account. Okay, now where it gets harder real fast is here in May 1. So on May 1, and what you're going to want to do, at least this is what I would recommend, is I would have a couple small little T accounts. I'm going to copy and paste this, not using my actual number though. And I'm going to reuse these. And accumulated depreciation. Now these are my little off to the side calculations, so you can see what's going on behind the scenes. Nothing updating my actual T account until I put it in a journal. But what I want to do, what I have to do on this one, is since I got rid of this equipment midway through the year at some point, not exactly midway, a third of the way, I'm going to need to do an updating depreciation expense for those first 4 months that I used this asset. But now what I have to do is figure up not only A, how much depreciation do I need to take, but B, how much accumulated depreciation will I have total when I go to sell this asset, because that will be important. So over here in my equipment little sub-T accounts, just for visualization purposes, I have an asset costing the $1,077,000, and it tells me I bought it in 2012. Now, as of this company's date here, it's 2015. So that means they have already depreciated 2012, 13, 14, and 15. They've already depreciated 4 years. So my goal then is I want to determine what is my actual total depreciation for this piece alone of accumulated depreciation at the end of this year, 2015, or the end of the most recent year? Well, to be able to do that, I have to figure out, first off, what was the depreciation for the first year. And it tells us I bought the equipment at the very beginning of the year, so it'll be a full year depreciation. Remember, all you do with straight line is you take your cost minus your salvage value, which it tells us all the equipment have a 0 salvage value. So your cost divided by your useful life. And it tells us down here in the instructions that all the equipment has a useful life of 10 years. So if you simply take the 1,077,000 and divide it by the 10-year life, just move the decimal, will tell us that I'm depreciating $107,700 per year. Now, if I do that for 4 straight years, just take this 107 times 4 years, this is what my accumulated depreciation would have been at the end of 2015. Now we're in 2016. In 2016, remember, I used the asset for 1/3 of the year. So I want to show that. Oops, I don't want to take the 430. I want to take 1/3 of my 107,700. Or you could have done 4 months out of 12, which would be the same, 1/3. I do the calculation. It tells me that should have been another $35,900 in depreciation that should have been recorded. So now I can come down here and do my first entry for May, because you're going to have 2 entries. My depreciation expense for what I just calculated, and my accumulated depreciation for the $35,900. Now, when I'm ready to sell it, I have an accumulated depreciation of the $466,700, leaving me with now a book value, and I think this is good to do. I have a book value, so remember that means your cost minus your total accumulated depreciation of $610,300. If I sold my piece of equipment for $646 and it's only worth $610, I brought in more than it's worth on my books. So therefore, I have a gain. And at this point, I am ready to do my second journal entry to actually record the sale. So my debit question, what did I get? I got cash of $646,200. And then I asked the question, why did I get the cash? Well, I got it because I got rid of my equipment. So I need to show that my equipment is now gone. So I'm going to skip a line for a second. Debit my equipment for that $1,077,000. Now, whenever you get rid of your equipment, you also have to get rid of the accumulated depreciation that goes along with your equipment. So I need to get rid of, I have a credit balance right now of $466,700, so I'm going to need to debit my accumulated depreciation for that amount, $466,700. Now up here, I determined that I had a gain. Remember, gains are treated just like revenues, or they're not. They look the same. They both have a credit balance. And if I add up my 2 debits, I have, as you can see down here, $1,112,000 and some, which is definitely more than what the equipment is worth as a credit. So my debits right now are more than my credits. That means my last entry needs to be a credit, which makes sense because I have a gain. So let's do that little gain calculation. I think it helps. So the cash received was $646,200 less the book value, which I just determined was right here. And so when I do this, I'm going to get a positive amount. And anytime I get a positive amount, that's a gain. So I have a gain of $35,900 on this disposal. Now what I can't forget to do is I need to update all of my items that have T accounts showing. So first thing I need to do is I need to go to the equipment, because this is talking about equipment accumulated depreciation, and I need to add in $35,900. I'm not worried about the cash T account, but now I need to take away from my accumulated depreciation for the equipment $466,700, because that was a debit. I need to credit my actual equipment. That's what my journal entry shows here. This $1,077,000. And remember, gain on disposal, these are treated like revenue and expenses, so they're way on the income statement items. They're not going to show up here in our assets. You're going to see why you need to keep these updated balances as you get further on into the problem. Okay, I'm going to take this calculation off at this point because we're going to use the same method to determine any time else I sold some stuff. We sold land purchased on June 1 for in 2006, and we sold it for $1,484,000. The land originally cost us only $409,000. Well, remember, with land, it doesn't depreciate, so there is no book value. What it cost me is actually what the book value would be. There's no actual calculation needed. So I can just go right to my ending point here and say I brought in $1,484,000. I got rid of something worth $409,000 book value. I have a very large gain at this point. I have a gain in excess of $1 million. So let's do the journal entry on June 1. What did I get? I got cash. I got cash for $1,484,000. Why did I get the cash? I got rid of my land. Part of my land is now gone that I've had for a while. If I got rid of it, I need to credit my land balance, and I need to credit it for what it's on my books for, the $409,000. And so I can come over here and do the same thing, credit my land that's gone for $409,000 out of my T account. Obviously, my debits don't equal my credits because I brought in a lot more than it was worth on my books. Therefore, I have a gain on disposal of this $1,075,000. Okay, we are now ready for July 1. July 1 in itself isn't hard at all. It's when we do the depreciation piece of it where it gets a tougher. So all we did here is just like when we had the land, all we did was purchase equipment for that $2 million plus. So we can ask ourselves, what did we get? We got equipment. That cost us $2,523,000. How did I get the equipment? I think somewhere in this problem it tells us that everything uses cash, so I paid cash for it. And that's all there was to that one. Simply now just update my T account. Now, what I want to do, and you'll want to do this too, bring this amount way further down so you know that it's not actually part of the old stuff. What I want us to do is actually have one temporary total for my equipment for now when I'm ready to do some depreciation calculations. Because I'm going to want to depreciate this old stuff, what I have left, for an entire year. But I'm going to depreciate this new stuff for only a half a year. So I'm actually going to have two depreciation items that I'm going to need to combine. That's what we're going to do here on this last item. Well, actually, before we get to that last item, we need to go ahead and do this journal entry, the December 31 journal entry, and then do our updated depreciation for everything else. So we retired a piece of equipment that cost $514,000 when it was purchased in 2006. No salvage value. was received, meaning we didn't get anything for it. So I need to decide, and I need to figure up, have I completely used this equipment? And if I purchased it at the end of 2006, that's actually I wouldn't depreciate it for one day. That's kind of misleading. It would be, you could think of this as definitely saying that I bought it January 1, 2007. So the very beginning of that 2007 year that I have used this $514,000 piece of equipment. And so my first depreciation would have been in 2007 as well. And remember, all equipment has a 10-year life, and there was no salvage value. So for a 10-year life, you just simply take the cost of the asset and divide it by 10. So each year, starting in 2007, I'm going to use the depreciate $51,400. Now, if you count up till the end of 2015, 2007, 8, 9, all the way up, we have now used the equipment for 9 years. So I simply just want to take this 51,000 times 9 to see where I'm at. As of 2015, I have a accumulated depreciation balance here of the $462,600. Now what I want to do to finish off is I want to depreciate for that last year. And since I got rid of it at the end of the year, I can depreciate an entire year's worth, another $51,400, because I used it the entire year. There was nothing to calculate. That gives me a book value of 0. So I received 0. I had a book value of 0. Therefore, I have no gain or loss. So what I want to do here for December 31 is A, show the depreciation that I just calculated for this piece that I'm getting rid of. And I just showed $51,400 in depreciation. So therefore, I need to add to my accumulated depreciation for the equipment $51,400. And that's what I'm going to put over here. This number got changed. This one should have been, when I redid the calculation, that's unfortunate. I messed it up here. My numbers are not going to be right now because I did a equals, and now that I've changed the numbers, those equals have changed. So you should have the right numbers. You can look back in the video to see what this should have been, because I don't know now. I'd have to go back and recalculate it. But anyway, this new number is, in fact, the $51,400 accumulated depreciation. What I'm going to do is I'm actually going to go back and pause the video at this point, and I'm going to go back and recalculate that. So we're just going to pause it, and we'll be right back. Okay, I think I have everything up to date now with my depreciation expense for my other piece of equipment recalculated here of $35,900, showing my cash and accumulated depreciation along with my gain. Notice the gain and the depreciation happen to be the exact same. That almost will never happen. I didn't realize that in the first time. That makes me think I may have done something incorrect, but I don't think I did, because my debits equal, or my credits equal $1,112,900, and these guys equal the same, so that works out well. Okay, so what I've done here, and we'll need to backtrack now to get up to where I should have been. My cost of this asset has been completely depreciated. I've now depreciated the last little bit of $51,400, and I put that into my accumulated depreciation amount here. And then all I need to do is retire this piece of equipment. So very similar to the question I did back on exercise 9-9. What did I get? I got nothing. What did I give up? I gave up my accumulated depreciation total, And that accumulated depreciation total is going to be the actual cost of the asset, because I've depreciated it now when I do this, when I did that last year, all $514,000. And when I get rid of the accumulated depreciation, I'm also getting rid of that piece of equipment that was valued at $514,000. So up here, I can take away this line for a minute, because that's not where I want to have the border. I want to have the border one more down. Here, my T account needs to show that I lost equipment of $514,000. Here, I need to show that my accumulated depreciation has been adjusted. And now we're at the point where I can do the final journal entry, my final big depreciation expense for everything I have left. So what we're going to do is I'm going to get a total here for the equipment, my old equipment that I still have minus what I got rid of. So it has a balance of the $47 million minus these two guys that I got rid of. And then I have this new piece of equipment that I got to do separately. And then I got to depreciate the building. So we're going to have 3 depreciations going on over here for calculations, and then combine them all into one big entry. And Wiley may have you set it up a little differently, but this is the basic premise. So we're going to look at the depreciation for the building first. This one will be the easiest one because nothing changed with our building. If we wanted to know the year-to-year depreciation, it's very simple. We'll just take that $28 million that we started with and divide it out over 50 years, because the building has a 50-year life. So every year I depreciate $578,860. For my equipment, I'm going to call this old equipment. I simply take what I have left of my old equipment, the $46,380, and divide that evenly out over 10 years. So I'm going to depreciate another $4,638,000 of equipment, old stuff depreciation. And I'm going to wait to combine it with my new depreciation of my new equipment. My new depreciation of the new equipment is simply this guy. And I'm going to divide it over 10 years. But then, because it's only a half-year life, or a half year that I used it, I need to show that I'm going to divide everything by 2 or multiply it by 0.5, either way. So I'm going to take this and divide it by 10, acting like it was a whole year, figure out what that is, and then take whatever that amount is and cut it in half because we only used it a partial year. Now I'm going to make these numbers into easier to read. We're going to format our cells. At least I thought I was. And I hope it doesn't lock up on me. Even if it does, you can, at this point, see what my depreciation expense will be. For the building piece, it'll be the $578. For the equipment piece, it'll be these two added up. And you had to do it separately to get this number to work out. If you would have combined your entire equipment, the old stuff and the new stuff, it wouldn't have came out exactly correct. So again, I wish it wouldn't have frozen up on me, and we could have finished this one out, but we were so close. We're 95% there, and we can go ahead and stop the video at this point for this problem of 9-5A.